Hey everyone, welcome back to another dividend investing video. Here today with another personal lesson in my own dividend investing journey. I often find myself looking for a discount. Who doesn't love a good value, right? But the more I get into this, the more apparent it is to me that the majority of the focus belongs on quality businesses that increase their cash flow year over year. The thing is that these businesses don't often come cheap. Now, Warren Buffett, someone who has influenced me greatly, has famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And with stocks on the rise, sticking with high quality is a must, because there isn't a lot that's cheap right now. And one stock in particular I've avoided because I saw it as expensive and overvalued, but I've missed out huge. So today I'm going to go over this company, why I think it's a great investment for dividend growth investors, and determine if it's a good idea to start buying into this one. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So the stock on my radar today is Hershey Company, ticker HSY. Best known for their tasty chocolate and snacks, the Pennsylvania-based company made news today of special interest to investors. So first off, Hershey announced its next dividend payment of $1.19.2. This is a 15.1% increase from its prior dividend of $1.03.6. This makes the 14th consecutive year that Hershey has increased its dividend payment, and the dividend was maintained during the last recession, but not cut. The dividend has been paid uninterrupted for 34 years. Now, this was above my own expectations at 15% raise, given some of the smaller raises we're seeing here in 2023, but Hershey's is in the financial position to do this. Hershey's reported earnings as well on Thursday, July 27th, with a small beat on earnings and a slight miss on revenue, and shares dropped on the news. Despite the company's overall strong financial position, they increased their sales by 5%, and the chocolate maker raised its full-year profit guidance. Still, shares dropped 3% on the news and are down over 10% in the last month. I'd like to see them drop a little more, but I also understand this is not the type of business that is usually made available for cheap. This is the stock I was looking at back in 2019. I was a newer dividend investor, and I passed on it thinking it was expensive. But that was a major oversight on my part. Over the last 5 years, shares have climbed 140%. Compare that to other comparable food companies, like say PepsiCo, ticker PEP, is up 68%. Mondelez International, ticker MDLZ, is up 68%. And both of these have strong dividend growth track records as well, but Hershey's has more than doubled their performance over the last 5 years. And on a total return basis, Hershey's has returned 167% in the last 5 years. That includes dividends paid out, and it totally outperforms the 75% return from the S&P 500. So the dividend raise caught my attention this morning. Then I checked out SimpliSafe Dividends, and for the first time in a few years, Hershey's valuation has come into fair value in terms of both dividend yield theory and PE mean reversion. So shares are trading at a forward PE of 23.5, just a hair below the 5-year average of 24.3, now trading in line with its 5-year average, when just a short few months ago this was around a 28 PE. And shares are yielding about 2.04% with this new dividend raise, bringing Hershey into fair value in terms of dividend yield for the first time in a few years. So by these metrics, this quote-unquote expensive stock is actually starting to look decent, reasonable fair value perhaps. It's down 10%. Maybe, possibly this is a chance to begin buying into Hershey's. So let's look a little deeper. It's no wonder Hershey's has been able to grow its dividend at 15% when its payout ratios are this attractive and low. For a consumer staple food company, you would expect higher, but Hershey's is only paying out 42% of forward earnings and 52% of forward free cash flow. SimpliSafe Dividends gives Hershey a safety score of 93, rated very safe. Companies like this are ones you want to just buy, hold, reinvest, and let it compound. And if you want a piece of that next dividend hike, you need to have your shares by October 17th to be paid out September 15th. Hershey's is a March, June, September, and December payer. Forward annual payout is $4.77. You got steady earnings growth, reasonably steady free cash flow growth, and this is what companies do to fuel dividend growth and price appreciation over time. Shares outstanding have been dropping over the last decade by about 9%, going from 227 million shares outstanding in 2013 to 206 million shares outstanding today, giving us investors a larger piece of the share of the company. Revenue is up over the last 10 years, going from $7.15 billion in 2013 to $107 billion in the last few months, increasing year over year. Increasing revenue, however, is nothing if it's an increasing proportion to expenses. But in terms of gross profit, operating income, and net income, all are on a steady rise over the last 10 years. Hershey's has a healthy return on invested capital at 26%. Another nice green flag with this company. Operating and free cash flow margins are looking solid, a 22% operating margin and a 13% free cash flow margin, both over the thresholds of where we want to see them. If there was a single negative here, I'd say their debt is on the high side, but even this I see is decreasing year over year since 2016, trending in the right direction. They obviously have very good management. The average analyst price target is $266.53, so analysts see about 14% upside from where we are today. The sentiment on Seeking Alpha is generally that the stock is too richly valued and the trends for sugar are negative, rated a hold. Seeking Alpha analysts, Wall Street, and Quant. But I think the stock is pretty fantastic. And I'm probably not going to be opening any new positions right now, but this is one of the top 3 stocks that I wish I owned that I don't. And I've been looking for an opportunity to start a position. Am I ready to start a position here? I thought it was time to do a proper evaluation of Hershey stock using some educated guesses and estimates, and I'll share that with you now. Alright, so what I like to do is take the average of 6 different valuation models. No one valuation model is perfect. They all have their pros and cons, so taking the average of them, and I can apply a margin of safety. That gives me a target buy price. Now, I don't base everything off this. This just gives me an idea of what I think the stock is worth. Because Hershey's is the kind of company that's going to come across expensive on some of these valuations, but I'm willing to pay a fair price for this one. So now we're in my valuation spreadsheet. I'll add the ticker, HSY. It gives me the share price. I enter the dividend yield of $4.77. This gives me a yield of 2.04%. And I've entered a forward PE of 23.5 and a forward EPS of 9.77. First, we'll look at Graham's revised valuation. Basically, all stocks in this high interest environment get roughed up by this model. With that 4.65% AAA bond yield, now, I entered an expected growth rate of 8%. That seemed reasonable based on the financials and the history of Hershey's. And I get an estimated share value of $138.67 by Graham's revised evaluation. Next, I look at a dividend discount model. Hershey's is going to do better on this one because it's a very strong dividend growth stock. Its historical 5-year CAGR is 9%, even though its latest dividend raise was at 15%. Now, I'm going conservative. I'm going to say the average going forward is going to be about 7% dividend growth over the long haul. And using a 9% discount rate, this gives me a fair value of $255.20. So Hershey's is undervalued by this particular model. Next, let's look at a discounted cash flow valuation. I entered a free cash flow of $1.631 billion with a growth rate of 5%, a perpetual growth rate of 2.5%, and a discount rate of 9%. Dividing the present value of free future cash flow by the number of 206 million shares outstanding, this gives me an estimated fair value of $139.05. So not great from a discounted cash flow perspective either. But as we saw, the dividend yield theory and the PE mean valuations, they're right in line with their historical. Dividend yield theory provides the stock a value of $234.98. And by PE mean, it would be at $237.41. I'll also factor in that average analyst price target at $266.53. So I factor all this together, this gives me an estimated fair value of $211.97. That's about a 9% drop from where shares are today. Not inconceivable, shares were there about a year ago, and in another month they could get there again. Of course, they could also go up 10%, but still I'm not ready to pull the trigger. Now, I think buying here is not a bad idea long term at all. In fact, it's probably a great investment, was my opinion. But right now I'm invested in a ton of companies, can only spread my capital so far. But if Hershey's drops to this $212 share price, I'm going to be starting a position with a few shares in some account somewhere. Notice if I needed a margin of safety, say 10%, I'd be holding out until $190. Not impossible, but I don't think that opportunity is going to come around. That really doesn't come around for stocks like this. Quality companies, look, you just buy and hold, preferably forever, and you're going to do pretty damn well. Now, I've been doing dividend investing for about 5 years now. The more I get into it, the more I realize I should focus on the quality at a fair value, more than I focus on fair quality at a discount. That's how you end up chasing yield. And I think the future is bright for Hershey's. So if you want to find more quality companies, I would like to look at dividend kings, right? Companies that raise their dividend for 50 or more years. And in this next video, I go over the top 5 dividend kings ranked by strongest dividend growth. So be sure you check that one out. Thanks for watching, my friends, and until next time, keep investing.